Okay, hello everyone. Good afternoon. Thank you for joining us in this lovely day. We would like to introduce Zoe Reich and Robert Cashmore, where they provide very valuable information about early stage finance for startups. Uh, Zoe, she is a managing partner at Octopus Energy, and Robert, he is a head of Middle East. Octopus Investments. Myself, Ibrahim Imam, I am the head of entrepreneurship department in Caxt. So I give you the mic, Zoe.
Thank you ever so much for the introductions. A real pleasure to be here and talking to you this afternoon. I'm going to share some slides for us to talk through today. Robert and I will be providing an overview of our respective topics, but it is always far more engaging and enjoyable if we have questions from the audience. So if there is something that you'd like to know more about or have a particular question on, please do jump in. It will make it more interactive and enjoyable for all. But let me just share my screen now. Fantastic. So this afternoon, we will be talking through the different financing paths of high growth companies, the range of financial products available, as well as the key stakeholders who are involved with those financial products. And then Robert will be talking in more detail about taking your idea overseas and how you can seek both financing and commercial partnerships in order to have that efficient and effective internationalization. But first, a couple of introductions from us, so you know who we are apart from two faces on the screen. Robert, would you like to start to say a little bit more about yourself?
So, good afternoon to everyone. I hope everyone is well. My name is Robert Cashmore. I'm the head of the Middle East for Octopus Investments. We're a fund manager based in London. I was formerly a British diplomat, living and working in Riyadh from 2015 to 2020. So I know Riyadh fairly well, though I didn't have the honour of visiting Caxt, but hopefully after this I'll do so. And Zoe, would you like to say a few words?
Thank you. So I'm Zoe Reich. I head up the venture capital activities of Octopus Energy. I will say a few more words of Octopus Energy in a minute, but I previously managed 7 venture capital funds, focusing on everything from pre-seed up to growth, Series B, Series C. I've also been an entrepreneur myself, having built and sold a cryptocurrency exchange, a market maker technology, so know the highs and lows of going through that journey, and also act as a UK government advisor in terms of startup and scale up policy. So to say a couple of words about the organisation from which we come to put what we say in a little bit more context, Octopus Energy is one of the world's fastest growing clean energy companies. We are predominantly focused on clean energy retail, so that customer-facing interaction, but have activities across the full clean energy value chain. And that means from generation through to grid integration, grid flex, retail, and then on the very other end of the scale, let's say engineering services, the likes of electric vehicles, charge point data. And very much a scale up ourselves in that starting in 2016, we are now in 27 countries across 5 different continents. So a lot of the experience of that scale up is brought in to our venture capital strategy, helping to back the next generation of entrepreneurs in the climate tech space. And we do that by being a very active fund manager that sits underneath this global energy company, managing 12 institutional capital funds with 7 billion in AUM that focuses on the efficient and effective scaling of technologies for the energy transition. Now we're here today to talk about startup funding needs. And mainly when we talk about early stage funding for companies, it is in terms of equity funding. And that is reasons for, and I will include, because debt funding is quite difficult at this particular stage and point of a company, in that when you are starting out, you often don't have the revenues or even profitability and assets in order to secure debt funding, the likes of loans, hence why many go to equity as the first point of call. So why would you therefore go for equity funding at this stage, selling in essence a very valuable share of your companies for investment into the organisation? And this really stems from startups typically beginning with limited resources and might not having enough capital to cover all their initial expenses, such as product development, marketing, hiring, operational costs, and needing that injection of capital to get off the ground and scale at the rate that they would like to. But it also goes into an aspect of risk sharing as well. Equity investors like venture capitalists and angel investors share the risk of that business. So if the startup fails, there's no obligation to repayment with a loan, allowing these startups to take on more ambitious projects without the fear of, a bit melodramatic, but let's say immediate financial ruin. But it's also access to the expertise and the networks that you may be able to gain when you take on equity investors, especially if this is in the form of specialist finance producers such as venture capitalists and angel investors who are looking to bring more than just money. They bring their expertise, their industry knowledge, mentorship, and valuable network that can help the startup to grow, make strategic decisions faster, and scale in that more accelerated manner. There are a couple more that maybe don't come to mind initially, which are also in terms of validation, credibility. Securing equity funding from reputable investors, there will be a very stringent due diligence process that will cover everything from the team to the product to the business model to market traction. And it acts as a very positive signal to everything from customers to other commercial partners to future investors that this is a credible and robust organisation that is being backed and a good signal to the market of somebody to do business with. But there is often also a greater flexibility in the use of funds with equity funding as well. So in some cases, when you take out a grant or a loan, there may be some very, very precise use terms of that financing. Whereas equity is normally more flexible and you can use the capital in a way that aligns best with the business strategy and needs. So it's for these reasons that really when we talk about early startup financing, it is predominantly equity that we are talking about, although not always exclusively. So the funding profile of a startup as it goes through that journey follows several stages, which we will go through in a high level now. And at each stage, you're looking for different amounts of funding from different providers in order to hit critical proof points across the journey that really allows you to raise the capital for that next stage of growth. So let's start with the pre-seed stage. This is really at the very beginning of that company evolution, where the purpose is to take your business idea and create a prototype or a minimum viable product and start to validate that with the market. At this very early stage, it is really the highest risk appetite. So often, therefore, relying on founders' personal savings, friends and family, angel investors, startup incubators and accelerators, those who have a risk profile that matches that incredibly early stage of investment. And usually you're looking to raise somewhere between 10 and probably at the upper end of the scale, $250,000 in order to get to that point where you can take on a more meaningful amount of capital and really start to develop your product. this takes us into that seed stage of development. Now, here you're looking to raise really onwards from $250,000 up to 2 million, 2.5 million. The amount obviously changes dramatically from startup to startup according to your capital requirements, but it's a really good rule of thumb. And when you're looking to raise that amount of capital in each round, it is fairly normal to be giving up around about 20 to 30% of your company in return for that investment. So that's why I said it is a very expensive way of capital. And therefore, you have to be very cautious about not only the amount, but who you are bringing on board as well as your investors. But this seed stage is really to conduct further product development, market research, and really to build out that initial customer base. So that when you go on to your Series A, this is about taking from those strong signals from the market, from saying, look, I've got a product, I found that product market fit, and we'll go into a little bit later exactly what that means. And now I am looking to really optimize, to refine the business model, to start on that early scaling journey. And whilst up until the Series A point, we've been relying on angels, incubators, accelerators, personal finances, very early stage VC, this becomes the main playground of the venture capitalists, where you are looking to raise what could be anything from 2 million up to it could be 20, rough ballpark, $1 million. And as well as the traditional VC, you also have corporate venture capitalists who play in this field as well. Corporate venture capitalists being linked to a corporate organization and really looking to fund these early stage companies for a mixture of strategic gain and financial gain. Now we'll go into a little bit more detail, some of the motivations between financiers of venture capital later, but really the Series A, it is that VC or CVC, corporate venture capitalists, that we see play in this field. And the last stage we will really talk about today, because it really takes us to, let's say, the end of that early financing landscape, is the Series B stage. This is where you're looking to raise, on the minimum, probably around about $10 million, and on the maximum, it can go up 100 million plus, to internationalize, to scale. You have one on your local market, and you are looking to take that traction and start to really expand globally. And this in particular later is where Robert's expertise will come into play, talking about how to do that effectively and efficiently. Before I move on, are there any questions at all on either equity funding as an instrument or some of the more generic stages of the startup journey? Silence is also fine. We can answer questions later. But please, if there is anything, do stop me as I go. Now, something that has really evolved in particular over the last 10 years is a greater expansion of financial products that can service this early stage ecosystem. And that's really because venture capital has gone on a significant global maturing journey, in particular over the last 10 years. If you go 10 years back, you were largely depending on the likes of family offices in order to back venture capital, government schemes, and it was pretty vanilla equity that you would often be going for. Now that has changed dramatically as you get a broader variety of needs on the startup side, a huge proliferation in the number of startup companies that are being generated, but also in terms of the demand of the funders of venture capital, those limited partners who put their capital into VC funds that then get allocated to investees. And we'll go into more detail in a minute of what those needs and dependencies look like, so you can have an idea of the full process from investee to venture capital to the backers of those funds, because it's important to get a clear idea of, I'm going to say, motivation and needs across that full demand spectrum to understand who you are ultimately pitching to when you were looking to go for capital. But as I said, over the last 10 years, the venture capital ecosystem and as an asset class has matured significantly. This is driven by a combination of factors such as technological advancement, increased access to capital, globalization, regulatory changes, and the evolution of the startup ecosystems themselves. The maturity of universities, technology transfer offices, innovation courses that are really stemming this, let's say, quality of innovative output that are coming from that origination sources. And it's led to a substantial change in the way venture capital operates. Its role in the broader financial ecosystem, impact on startups, innovation, and financial products. Just some examples of those outputs being a huge proliferation in the number of venture capital funds. In the US, which is the largest venture capital market in the world, there are over 2,000 venture capital funds. Now, it's difficult to put a number globally, but it is definitely in excess of 5,000 venture capital funds. And as you get this proliferation, you also get a specialization throughout that pool as well, looking for thematic investing per stage, per sector, meaning that when you're going out to select your investor base, you're often now looking for a much more of a specialist entity rather than a sectoral generalist. So leading to careful diligence when you're going out to select your investors. But also an introduction of new financial instruments as well. So going from a system where there was relative capital scarcity to one where there is a lot more capital, you've had to move to financial instruments that are increasingly founder friendly in order to win out in terms of this competitive market. So that comes with products such as safe notes, which are simple agreements for future equity, convertible loan notes, revenue-based financing have all become increasingly popular as opposed to just traditional equity. Although, as I mentioned, that traditional equity still takes up the majority of what you would be looking for at an earlier stage. And interestingly, a greater institutional participation in venture capital as well. And this includes the likes of pension funds, endowments, sovereign wealth funds, significantly increasing their allocation to venture capital as part of a broader strategy to gain exposure and to support these high growth sectors. And as I mentioned, we'll go into that in a little bit more detail. But with this rise of, let's say, professionalization, institutionalization, you've also got a greater focus on reporting and ESG. So your environmental, social, and governance criteria, making sure that your companies are reporting effectively against the different targets of sustainability, which is increasingly important to the institutional investors looking to allocate into this space.
We've had a few questions.
Fantastic. Please ask them. When I've got my screen up with the slides, I can't see questions.
If you go to the previous slide, there's a question around the timescales that you see between those stages.
So this.
No, I guess previous slide about the development. So the question from Dr. Al Hassan, if I remember him, he founder of Nanopalm in health and nanobots to cure sickle cell diseases. So his question is, what's the difference between product development or company development? If they may mean the same, like in the case of like pharma sectors.
I'll answer that two ways. There's one about timing, there's one about product and company development. So timing greatly depends on the type of company that you're looking to grow. The company just mentioned is a very deep tech company, high research based. It is going to take quite a period of time in order to go from lab to a demonstrator to something that is commercially ready. So that's why if you look at the profile of a deep tech company, the value stays pretty low for a long period of time, and then you have that significant value inflection point after say in the medical field, you've hit your different regulatory pathways, as well as your ability to sell into a public healthcare system, for example. So in general, you can often talk about a 2-year period between different financing rounds. But whether you need a seed plus, Series A plus, that will often depend on the type of company and the value inflection points that you manage to hit. Now, something that has influenced that quite significantly over the years is there is a lot of capital availability at that Series A point where you've managed to hit traction, demonstrated traction, but actually the number of funds or angels who are happy to go earlier when you've still got a high risk profile has been relatively low, or scale up funds who are happy to underwrite that pathway to adoption before you have, say, 10 million in ARR. So we talk about these capital challenges at the very early stage and at the growth stage as well. And how quickly you can progress through will often depend on how well you can navigate that challenge, which also goes to my point of us seeing more specialist funds and players in the ecosystem who can better navigate due diligence those tricky areas in order to try and overcome what might be a greater length of time between company inception and getting to a scaling point. And then the question also was about, is product development different from company development? Very much yes, because you would hope in terms of these high value companies that there are multiple products that are being brought to market in order to have ultimately a high value company. So product development actually sits on different, let's say, swim lanes versus general profile of company development. Does that make sense?
Actually, makes sense. Yeah, actually, what the challenge we are facing as like entrepreneurs in deep tech or research-based startups, that they are like in the labs and they want some investment rounds, but still they are not in the development. So as what Dr. Mohammed Al-Umari said in his questions, what are the resources available when transition from product development stage to the clinical trial phases?
Yeah, it's a really difficult period of financing. And this is where when you look across the globe, I can talk about a scheme we have in the UK, but it's mirrored in the US and other geographies as well. This is where it's often the public sector that steps in to say that these are critical technologies, they're going to have significant impact on environment, social health, well-being going forward, and therefore we need to take that risk in order to enable more capital from the private sector, and act as a catalyst for that. So, for example, in the UK, we had a scheme called the University Seed Challenge Fund, which was there precisely to take that risk. It was public capital that would support going from lab to field, shall we say, not quite through the different stages of clinical trials, but at least up until a point where the private sector can step in and say, right, this is now a risk profile that we are happy to take on board. So really going to the increasing interplay between government, universities for the type of technologies you're talking to, and then ultimately the private sector as well. And I can talk at length about some of the different schemes, but really the emphasis is on that increasing importance of the interplay between the three.
So you suggest that they are looking for like public fund or grants rather than investment in the private, right?
It comes in multiple forms. So some of it is grant funding, some is it we've seen in the UK, it was a non-recourse convertible loan note. So it comes in many different forms.
Loans. Okay.
Or you also have a significant public backing of very, very early stage funds. Again, to pick something that's very close to home for me, you have something called the British Business Bank, which can fund up to 2/3 of an early stage venture capital in order to help leverage that private sector funding, but spread the risk to encourage greater capital at this point. And this is very much where the public sector has come into its own in saying that we recognise the importance of these high growth technologies for long-term sustainable growth of country PLC, and have to step in to do something.
Yeah. Sounds good. So you can just continue.
Fantastic. Just get here. Brilliant. So we started to say that there is an increasing mix of different limited partners, the funders of venture capital funds, who are looking at allocating into this sector. And it's really for several strategic and financial reasons that we'll go through in a little bit of detail. But this spreads everything from pension funds to corporates to family offices, endowments, as well as more traditional financial institutions and government sector as well, which we've covered. Now the main draw has to be that high risk, high reward profile, with venture capital offering the potential for outsized returns compared to more traditional investments such as stocks, bonds, or real estate. And it's this high risk nature of the very early stage companies means that successful investments can yield significant multiples. You will generally see most venture capital funds targeting between a 3 and a 5 times return in comparison to that more traditional, say, financing mix. But the other is in terms of diversification of investment portfolios. Venture capital is considered as an alternative asset class in order to provide that diversification, and as part of a broader portfolio mix can reduce correlation with traditional assets like public equities, fixed income, and therefore reducing overall portfolio risk. The other is very much exposure to innovation, giving LPs exposure to innovative technologies, business models, industries that it sometimes is quite difficult to access through public markets or other asset classes. And again, it's a long-term investment horizon. We spoke a bit about that length of time from the early stage journey into maturity. And many LPs, such as particularly endowments, pension funds, have long-term investment horizons that align very well with that growth profile, where it could easily be 10 years plus from initial investment until hitting a point of maturity. And then particularly on the corporate side, it's also about access to innovation, market disruption, looking to stay ahead of trends. For example, as an organisation ourselves, Octopus Energy have made over 125 venture capital investments in order to assist with things such as market mapping of innovation, long-term sustainable growth of our own organisation. So that's why I say, as an asset class, it's a little bit unusual. It's a lot about strategic exposure and gain, as well as financial. And this is the mix that we see in terms of the LP base of a venture capital fund. And then you've got all the slightly more boring things of tax efficiency, tax advantages, filling very specific investment mandates. But those are some of the key different criteria that the LPs are looking to leverage when they have access to venture capital. Now, I've just said that people try to access venture capital because the potential for higher returns. That's absolutely true in that successful VC funds can achieve IRRs, this internal rate of return linked to the time value of money, of 20 to 30% or more, especially if they invest in unicorn startups, which are valued at over $1 billion. However, the mean IRR of venture capital funds is often lower, typically ranging from 10 to 15, and the majority of venture capital funds actually lose money. So this goes to the very careful selection and why it is such a high risk, high reward asset class. And a lot of that potential to lose money goes to venture capital very much depending on the power law. And by the power law, what we mean is the idea that a small number of investments in a portfolio will generate the vast majority of the returns to that portfolio. It's a very skewed distribution. So unlike traditional investing, which might follow a normal distribution, that bell curve, VC is very much this power law skewed distribution, meaning that the majority of startups you could expect to have either 0 or 1 to 2 times. And really, in a portfolio of 20 to 30, it could just be 1 or 2 companies that really deliver the returns to the fund, targeting 10, 100x or even higher on the initial investment. So going to my point that a lot of VC, majority of VC, don't actually return positive capital back. If you miss those 1 or 2, it becomes very difficult in order to achieve those market-leading returns. That's why most VCs will talk in depth about their diversification within the portfolio, how that's mapped out in order to make sure that they capture those 1 or 2 superstars. Any questions on power law or even further in terms of portfolio construction of a venture capital fund?
Actually, we have a couple of questions from Dr. Majid Nassar. If product passes evaluation stage and reaches the deployment and upscale stage without getting investor support, is it considered early or mature?
Well, it's just a different funding pathway. It's a bootstrapped company, so one that is made off their own capital without having to seek external investment, i.e. the founders are likely to have 100% equity. That doesn't mean you obviously won't take on external investment in order to scale. That is also relatively common. It's just that you haven't necessarily had to go for that external equity funding earlier. So the maturity of the company is really related to where you are in terms of having product market fit, product that goes to market, operational scale up. It's not necessarily just linked to you being at Series A, Series B, but it's a different funding pathway to what we've discussed today so far.
Okay, the second question is how and when we do achieve the break-even point?
When is it expected? Now this goes to whether you are building a B2B SaaS company, i.e. software company, or whether you're building something similar to the biotech company that was mentioned earlier. The capital needs varies hugely. Now, if you are a B2B SaaS company, it might be expected for you to reach break even between Series A, Series B, potentially. That is a norm that is out there at the moment. Your cost base is much lower than if you have very high capital requirements, need to fit out a lab, wet rooms, significant capital trial expenditure of a deep tech company. Now, interestingly, this is not quite the question that was asked, but I'm going to answer it anyway. Interestingly, you can have substantial exit of deep tech companies even when you haven't achieved break even, i.e. it is still a technology exit. And whether that is the prevalence, that really goes to the different maturity of the VC ecosystem in different geographies. For example, it is not the most common exit option in the US, but it is in Europe because we have a drastic lack of growth scale-up funding. So actually M&A, trade sale buyout at that technology stage when deep tech companies often are not EBITDA positive is the norm. So to answer that in a roundabout question, I hopefully have. Any other questions?
Yeah, actually we are good now. So maybe later we can just receive questions.
Of course. So what are VCs therefore looking when they're trying to find these outliers? We've started to talk about this already, but it is all about that product market fit, product channel fit, model channel fit. How much evidence can you give that you are developing something that is in critical need from the market? Now, often these are somewhat easier to achieve if you are a B2B SaaS or a software company. because you have seen a market demand, you are developing your code, your product, your application layer in accordance to what you deem to be a need from the market. You can test it very readily in terms of getting an initial version out there, user feedback on it, and look to go and scale from there. What is much more difficult is in these deep tech companies, in that often this, let's say, innovation has come from academic research where there was this spark of commercial potential, and it's created a product that is then created a solution that is then looking for a problem in the market. And what is not helped by is that if you go to those initial proof of concepts, i.e. trying to get an initial customer in the market to validate your product, globally, 2/3 of those come from marketing budgets of large organizations, rather than necessarily the business unit that is going to adopt and scale. So there are a lot of false signals out there in terms of whether you have achieved this product market fit. And that is why so many VCs look to, say, your annual reoccurring revenue to try and assess whether that's been achieved, but also why it is so difficult with deep tech companies, because you can viably get to a Series B funding round without having any substantial ARR because of the cost of the capex cost of getting to a product that is just inherent with those types of technologies. So this goes again to my point that we are seeing much greater specialization within the venture capital industry that is able to underwrite those risk pathways of deep tech versus what I'm going to say as more standard tech, more software focused organizations. Now, we've talked about why people want exposure to VC, the different opportunities that are out there, but it's also a fact that there has been a decline in VC capital over the last couple of years. And this can be very much attributed to a combination of macroeconomic factors, market dynamics, shift in the investor segment. And just to give some examples of those, rising interest rates are definitely one. So raising interest rates in order to combat inflation, highest interest rates make borrowing obviously more expensive and reduce the appeal of risky investments such as venture capital. As the banks increase the rate, there's less liquidity in the market. Tightening liquidity therefore also affects the flow of capital into asset classes like VC, as well as, say, public market correlations. The decline in valuations in public markets, especially in high growth sectors like technology, therefore has a ripple effect downward into the private markets as well, seeing stocks fall, valuations fall, that make it a more risky, let's say, sector for LPs to enter into. However, it's important to say that that decline is unlikely to be too substantial, too long term. We do see market corrections, but also that there are always strong geographical disparities in terms of the share of venture capital financing and where these macroeconomic conditions are hitting most. So this is very much where I look forward to handing over to Robert to talk about how you can look overseas, when to look overseas, and some of the different considerations of doing that when seeking both capital and commercial partnerships.
Thank you, Zoe. Yes, what I'm about to talk you through, I've built up these experiences both in my former job as a diplomat working with British businesses who were looking to grow into Saudi Arabia and the Middle East, and also working at Octopus Investments, as I do at the moment, talking to entrepreneurs and to startups who are looking to internationalize. And when one talks about taking businesses and ideas overseas, the immediate reason for that, one would think, was because there's new customers overseas, their growth market for a business. But actually, there may be more strategic value and relevance to taking whatever your product or service is, taking it to a different market. If you look around the world, there may be better market fit for what you do. And you also may be able to access different pools of capital which don't exist at home. And Saudi Arabia is the best example on earth, I would argue, when you think about that. And at the end of this part of the presentation, I'll give you an example of a British startup run by a very successful entrepreneur, a spin out of Cranfield University called Solar Water. And this was a desalination technology whereby this particular entrepreneur had built a large greenhouse which desalinated water at large scales. And you won't be surprised to hear that he couldn't find much of a market fit in the UK for that. We have lots of water which doesn't need to be desalinated, and also we don't have a great deal of sun. Whereas in Saudi Arabia, there was a need for fresh water. This water usually needs to be desalinated. Companies like Aquapower have built empires doing this, and Saudi Arabia has huge amounts of sun. So indeed, he looked overseas and took his idea overseas to Saudi Arabia, and was successful in doing that. So when thinking about taking your business, your idea overseas as an entrepreneur, the first thing I would encourage you to do is to lay strong foundations in thinking about the places, the markets, the countries that you want to take your idea. And honestly, some people do not do this. Some people do not do the basics to understand the culture that they are trying to take their idea to. For instance, the importance of face-to-face interactions. Do you need to spend time talking to funders, getting to know them, getting to know about their interests, their families, etc.? Or is it a very transactional environment where that sort of thing doesn't matter? The funder just wants to hear a good idea and will take a decision on whether to invest or not to invest. These things matter to do these basics. Simple things. I've seen people make mistakes when trying to take businesses from the UK to the Middle East. They haven't done the research on what are the working days and times in the countries that they're trying to take their ideas to. Public holidays. For instance, I had a gentleman who was trying to take his business, which was a growth stage business, into Riyadh. He couldn't understand why he couldn't get meetings on Fridays. And he hadn't done the basic research to understand how to do business in Saudi Arabia. And it wasn't a good start to things. It's important to take time to understand business practices. I've already touched on the importance of interpersonal relationships in some markets, to understand how fast the transactions usually take. So if we were to take, for example, compare New York to Riyadh, the speed of transactions in New York may be much faster than the speed of transactions in Riyadh. Again, back to the importance of building interpersonal relationships in the Middle East versus just the transactional nature of businesses in other parts of the world. For buyers and investors, it's very important for an entrepreneur who's looking to take his or her business overseas to understand the nature of buyers of services and goods, and indeed in investors. Is the investor public investor or a private investor? So public and private investors may look at things very differently. A private investor, for example, a small family office, may be focused on just getting a return on their capital invested. Whereas if we look at a public investor, they may have a whole range of KPIs that they have to consider, such as, is their investment going to create jobs on the ground in the location they're investing from? Is their investment going to help drive a new sector in the market they are active within? So you have to understand the nature of these investors. Can the capital that this investor is looking to deploy, can it invest in overseas companies? I've had Saudi investors come into the UK in the past, bidding for investment from UK investors who cannot invest overseas. And of course, that was a complete waste of time for both parties. So it's back to getting to know your market, doing your research, and then tailoring your approach to the market and the way you're selling and trying to raise capital to those investors and to those markets. Moving on to the role of embassies. When one thinks about embassies, generally speaking, people just think these are places that issue visas. And having worked in an embassy for many years in the diplomatic quarter in Riyadh, I can tell you this is completely incorrect. They are real centres of commercial expertise. And if you are a Saudi entrepreneur with a startup business that you're trying to take to, for instance, the UK, I would really encourage you to think about how you can use the Saudi Embassy in London to help you to gain an insight into the UK market, into UK investors, how you can meet these people. And the commercial teams within embassies are teams that you should really think about developing a relationship with. They're real experts in their field across cultural, commercial, and investor-related matters. They can often provide you with free promotion services. So taking the idea that you're trying to bring to, for example, the UK market, they can promote it for you for free. They can make introductions for free. They can do lots of things that will help you make good use of your time. Embassies also often run things called trade missions, and these are often thematic. So, for instance, the Royal Saudi Embassy in London may be hosting a financial services or a health tech trade mission in London at some point in the future. And if your idea and your business that you want to bring to the UK market meets with that theme, then you can apply to join the trade mission, and you'll get exposed to investors, you'll get exposure to potential customers, and they can be great ways to make those sort of links. So all in all, as entrepreneurs, as people running startup businesses, you're very restrained in terms of your time and your general resources. You need to make good use of them. And I would really encourage you to look at embassies as a way to help you do that if you're looking to take your ideas overseas. It's very similar when it comes to the role of partners as well. In some places, you have to have a partner. It used to be the case in Saudi Arabia that you had to have a partner on the ground to do business with. Sometimes people want to do things solely on their own. But coming back to thinking about getting an understanding, that foundational understanding of the culture, the commercial environment, and the types of capital in the country that you're looking to take your business to, could a partner help you learn those things very quickly? Probably yes. In many cases, probably yes. So looking to find the right partner and looking to learn from that partner is a very important thing. And it comes back to how do you make the best use of your time and resources. If you've got the right advice around you, you'll be on a good footing to do that. Maybe a local partner would be very helpful in helping you to distribute your goods, distribute your services in the country that you're trying to expand your business into. Of course, that will make things very attractive for local investors if they see you've got a good business plan with which to do business in the country you're expanding into. It's a good thing when you're trying to apply for finance. In summary, when it comes to partners, if you're trying to expand into a geography and you don't know a great deal about it, then finding the right partners may be a very good way to do that. Aligning with overseas government policies, I think this is something that a lot of entrepreneurs who are looking to take their businesses overseas don't really think about. And there are multiple reasons that you should be looking at what government policies are looking to do in the country that you're trying to take your business and your ideas. And there's many reasons to do this. And I must say the UAE has been very good at doing this, especially the Mubadala investment company, who some of you may have heard of, Abu Dhabi-based sovereign wealth fund. When they expand their businesses overseas, especially their startup businesses, many of which are at the growth stage, they'll really try and help those businesses align with the government policies of the country that they're trying to grow into. Why do they look to do this? Well, if you are aligning with government policies on the ground, you're probably going to have more success. There's going to be more state resources behind that sector, that area of idea. And if you can align with that, you'll probably do very well. You'll probably find more government help if you're trying to align with an area of government policy too. For example, the embassy in the country that you're trying to grow your business and your ideas into, they're probably going to help you more if you are doing something which they're trying to achieve on the ground of the country than if you're doing something completely different. Again, if you look at investors and if you look at local partners, you're more likely to be attracted to an investor and to be attracted to a local partner if you are trying to do something which the government in that country is trying to do too. And also, when you look at customers, if there is a government drive to achieve something, and if we look at Saudi Arabia at the minute, things like tourism, things like entertainment, things like sports, If consumers are aware of these things and they're in the news, they're more likely to consume them. So if your business that you're looking to take overseas is aligned with government policies, it's more likely that consumers will be interested in consuming your products and services. And the last point, looking at the types of capital which you may be trying to win overseas. Again, back to that private capital or public capital. If you are looking to take your business and you're going to create jobs overseas, if you're going to help develop a new sector overseas, if you're taking a new technology which you've developed in Riyadh or wherever it may be in Saudi Arabia and you're trying to take that overseas, you're much more likely to be ticking the boxes of what an overseas public investor is looking for, because they're trying to create jobs, help develop sectors and to bring new technologies into their country. And therefore, if I can take an example, actually, the Saudi Ventures company, who I'm sure you're all familiar with, based in Taft in Riyadh, they're not just looking to invest in companies growing into Saudi Arabia because they want to generate a return on their capital. They won't throw their money away, but they're looking for much wider KPIs. Are these new companies expanding from the US and the UK into Saudi Arabia, creating local jobs? Are they opening local offices? Are they helping develop new sectors in Saudi Arabia? If they are ticking those boxes, they're much more likely to invest in those companies. So if your goods and services that you're looking to grow overseas are helping do those things, then applying to overseas public capital is something you should certainly be thinking about. And if I may just finish with a case study, that UK company called Solar Water that I mentioned at the beginning of the presentation, they managed to win a contract with NEOM, a $100 million contract, which for a relative startup at the early growth stage UK business was just a phenomenal result. And if we just look quickly at how they managed to achieve that. So as I said at the beginning, they're a UK startup, a spin out at Cranfield University with a new type of desalination technology using the power of the sun. They were struggling to gain financing in the UK at the stages that Zoe's already covered. The university helped them at the seed stage, but as they tried to scale, they couldn't raise the capital. So they looked at their product and they looked around the world to see if there were overseas locations with a better market fit. And of course, they landed on Saudi Arabia, which is well accustomed to desalinated water and has a lot of sun. Perfect. They did very well building their foundational knowledge. They learned a lot about the market and they learned a lot about the customer base and investors. They engaged the British government. They engaged the British embassy in Riyadh. They spoke to the commercial teams and they got very good advice from potential financiers, from potential customers, did all their research, had a good cultural knowledge of the people they're about to start selling to and about the capital that they were trying to raise. And they landed on targeting NEOM, the NEOM investment fund. And based on this strong market fit and based on their good foundational knowledge, they had very productive conversations and ended up winning that contract for $100 million. And as the Solar Water example shows, they were successful in moving their business overseas into the Saudi market because they thought about all the things which I've just talked about in this presentation, and they pulled them all together to have a fantastic outcome. Are there any questions that anyone has on looking to raise overseas capital and looking to grow your businesses into overseas markets?
Okay, thank you, Robert and Zoe. Well, I have a couple of questions, and then we could open the discussion and the mics for the audience. The first one is, what are the suggested resources for the for early stage fund? So, like bootstrapping, as what you mentioned, or Zoe, as what you mentioned, bootstrapping or self-funded, or just secure the grants or early stage investors. And the second question linked to this question is, which one is preferable for the later stage investors? So what are the what are the attracted startup in the matter of the early stage funding?
I didn't quite get the first question, so I'll answer the second one first and then ask to clarify the first in a minute.
Good.
But in terms of what makes you interesting proposition for growth capital, I mean, there are going to be the hygiene factors of whether you are very much eligible, which are things like you have to have a cap table that works for growth. For example, there's a whole load of different features within that, but the key members of the team that are active in the growth of the company going forward, they have to be very much in line, have a good equity stake, also going to get their upside from driving the growth of the company. Actually, what we see as a growth stage investor often is sometimes that cap table isn't aligned with the growth of the company, and therefore we have to do a restructuring of the organization before we can put capital in to make sure that everybody is incentivized to go forward. Now, that is just one example of a hygiene factor. There are a whole host of others in terms of IP, ownership, freedom to operate, etc., etc. But what makes you appealing as a growth company? Now, where most growth stage investors look to play is that you are at that optimization of risk. There's no longer any technology risk, i.e., you have a product that is being sold in the market and is working, yet you are not yet valued off your ultimate market traction or your market traction. You're still being valued off largely the novel nature of your technology, and we are funding what we hope to be that significant uptick in value that's going to come from internationalization, more boards roll out, maybe the bringing of secondary product lines to the market. So what's going to be appealing is you giving enough confidence that you've de-risked on the technology and product, but that you've found that product market fit. And that is absolutely a term that you will hear again and again, that now all we have to do is to be able to underwrite that onward pathway to adoption. We more need to assess the market and the team's ability to enact on it, rather than the underlying technological risk, etc. So that's what's going to really give your investors the most comfort, that you are as de-risked as possible on the technology and product side, and actually all they now need to do is to be able to understand the adoption curves and the risk that is associated with that, if that makes sense.
So you mean they are ready to getting to go through the risk of the market, not the risk of the technology itself?
Yeah, so growth stage investors are very rarely wanting to take technology risk. I mean, if you are bringing a new fusion company to the market, your Series B investor, there will be some technology risk remaining. But mainly they want to focus on the adoption risk. So that's what they are going to be happy to assess and underwrite. And you need to be able to give comfort and confidence that tech products, to a larger extent, team risk is largely mitigated against already.
Okay, when you mentioned the cap table, you mean the ticket size for each investor, or you mean the percentage that available for investment?
So when I mean you have to have a cap table that is investable, I mean in terms of the current share allocations between the different ownership of that capitalization table. So making sure that, for example, it isn't a cap table that is just full of owners who are no longer contributing to the onward growth of the company.
Okay. The first question was the suggestions for the funding for the early stage. So what do you suggest, that self-funding or bootstrapping early stage investors?
The equity funding is expensive. It is very expensive. As I mentioned, you're likely to be giving away 20 to 30% of your company. And really, the percentage that you ultimately give away is going to be dependent on how many lead term sheets you can get. Valuation of company is not a science. you will hear many metrics that are put out there in terms of, oh, it has to be, I don't know, 2 times increase on your last round or a revenue multiplier.
Yeah.
Your valuation is ultimately what an investor is going to be willing to pay for your company. So equity financing is expensive. If you can get away with bootstrapping, many prefer to do it because you are not paying with equity. But the downside is that it could affect the rate of growth that you can achieve. And that's the equation that most founders are doing in their mind. Can I bootstrap? But equally, how long is that therefore going to take to the market? Do I lose the advantage that I potentially have now in terms of building a product that is fit for a current market need versus the cost of giving up equity?
Okay, thank you. By the way, everyone in the audience, we just allow you to unmute yourself, so anytime you can interrupt and ask your question. If you would like to ask a question.
Excuse me,
Oh.
regarding the company, the solar company that works with NEOM, can we get the contact for the company?
Oh, yeah. I can share that.
Thank you. Appreciate it.
Okay, Dr. Mete, you can just unmute yourself and ask question. Yes.
Yeah, we are really glad to having you in this workshops. My quick question is for a startup basically doing software based related to medical image analysis. Would you suggest doing the model as a business to customer or business to business?
So I think that's quite a difficult field to do a business to customer model, in that on majority in most healthcare systems across the world, it is predominantly served by a public healthcare system rather than any kind of private analysis. And even in that case, even if you have a private system, you're still going to be trying to sell to the private healthcare imaging sectors of the hospital. So I can't really see how that works, but also not my field of expertise either, obviously sitting underneath an energy company. But it seems like it's naturally a B2B model. And actually, where I've seen from some of the exposure I've had to health tech in the past, it's often a sale not to ultimately the end user, the hospitals. It's actually to the let's say scan provider, who therefore your software might be an additional package that they sell alongside a whole load of other things. So unfortunately, not my field of expertise to go into any level of depth on.
Yes, thank you, thank you. Any other questions? I will get some questions from the chat. Dr. Al Hassan asked again about the matrix between the seed round or Series A. So what are the metrics that VC ask the startup?
So I guess most of the metrics are going to be in relation to the market traction that you've been able to generate. Because as I mentioned, VCs, and even though you might have specialist VCs that are looking at deep tech, they are unlikely to be a specialist VC that is only going to look at, say, a photonics aspect of deep tech. So in order to really assess risk, it is, do you have a product that is meeting demand of the market? It's always going to be those traction signals that are going to be most keen in VC's mind when they are assessing your company. So maybe easiest to work backwards, some of the very standard metrics that are out there for a Series V company is having $10 million in annual reoccurring revenue, being a good indication that, yes, you've got a product that is gaining traction, and that is a solid revenue base that can then be built off if you put greater equity financing into that company. So what that might therefore look at the Series A point is in the order of 2 million annual recurring revenue. And then at the seed stage, it's really when you've got a product, you've got those proof of concepts, and you were just starting on that real sales journey. So revenues is one, and that's how you can best assess product market fit. But it also goes to the likes of team. Again, at the Series B stage, you would be expected to have a fully built out, well executing, proven track record of C-suite. At the Series A stage, there may be a couple of missing key factors. It's often at this point you bring in the likes of an FD or financial director, CFO, or you might be building out, splitting your product and your engineering streams. So you might not yet have something like a chief product officer. And at the seed stage, it's often CEO, which is usually the founder becoming the CEO, and a pretty small team. It could be 3, it could be up to 15 of you. So you're not going to have that fully built out suite. So the metrics all scale roughly in accordance with that. So you'll be looking at revenues, team. It could be in a deep tech company, IP filings, whether that's converted into patents. What else? In terms of how developed is product line 1 versus product line 2, 3, and it's that rough sort of scaling pathway that follows those other metrics that I've already mentioned.
Yeah, regarding the team, we commonly see this structure especially in the deep tech or tech company or startups, that they are like some structure are like 3, 4, 5. Some of them I see is like 10 people, that founding team. So what do you think about the suitable number for the founding team or co-founders, that they have shares in the company?
Yeah, so deep tech is a really challenging one, because for 2 reasons, really. There could be a large number of people who work on the underlying IP who are seeking for founding shares in the company. And also the initial technical minds who have gone towards the creation of these IP are unlikely to be the key commercial minds that are going to take this company on a significant scaling journey. Now, that is not always the case. You do see academics go into founders and then become very successful commercial heads of the company, but it is in the minority of what you see. So often in deep tech, you see a significant team transition around that Series A point, where the more technical founder might go to something like a chief scientific officer, chief technical officer, and you have to bring in a CEO. So back to your question, it's challenging because there has to be enough room on the cap table, enough equity to be given to the team that's going to support onward scaling. So I would say for deep tech, we often see teams at the seed stage that might be more like 5 to 10, and then that obviously scales with the different rounds going through. But my advice, and where we've seen challenges in the past, is the team that contributed to the IP, their equity has to be proportional to the contribution they made to date, but not necessarily, they're not necessarily going to be the key drivers of the onward growth of the company going forward. And that's a really difficult and challenging balance to get.
I have a question.
Please.
Yes, please start.
So follow up on Dr. Zali comments, what are the major risks that I need to de-risk and for us founders to be looking at compared to a perspective of VC or investor, or perspective of business development?
So you mean the different risks if you're looking, when you're talking about business development in terms of selling into a corporate versus who are your financiers?
Because sometimes I need to look at both, but my question was like the biggest de-risk that proves not only I'm capable of going to the next chasm crossing, but to prove that me de-risking this is something that investors care about and BDs care about.
I'm going to answer that in a slightly different way, but it will answer your question, which is in between rounds, your financiers are generally looking for a 2 times valuation uplift of the company as a minimum. So they want to see that you can hit enough value inflection points that are going to warrant your valuation to double between financing rounds. That's how, as a VC, you protect against the dilution of your equity stake and are still looking for substantial returns from an investment that you might make into a company. Now, in order to achieve that 2 times valuation uplift, you're obviously going to hit proof points at the early stage in terms of technological risking, team build out, at the seed to Series A stage in terms of product development, evidence of market fit, and at the Series A to Series B stage in terms of more mass market appeal, scalability, ability to take the product beyond the home market. So those are the key areas of risk that you're going to be assessed on the different stages. But as I mentioned, it's really about the valuation uplift, the valuation inflection. Ultimately, your investors are there in order to make a return, and that has to be both in terms of scale of returns, but also the time-bound nature of it. So it's how can you achieve that 2 times uplift, but in a timely manner as well. As you all know, in terms of time value of money, getting a 2 times return today versus in 5 years is very, very different. And most venture capital will have an average hold time baked into their portfolio construction. At the seed stage, it might be 7 to 8 years. At the Series A stage, it's more like 5 to 6 years. At the Series B stage, it's more like 3 to 5-ish years in terms of how long they want to be able to be holding these assets to then exit to get their returns in a timely manner. So that answers it a little bit differently, but it shows you some of the calculations that your financer will be making as they think about the risk of your company.
Thank you.